Stocks are recovering, gold is recovering, but crypto is still struggling. While everything else has bounced, digital assets are still under pressure. And for most investors, that feels like the beginning of something worse. But Cathie Wood argues it's actually the final stage of a temporary squeeze that's already starting to unwind. In her latest In the Know update, the ARK Invest CIO explains why crypto's lag doesn't signal weakness. It signals sensitivity. When liquidity tightens, crypto gets hit first. When liquidity returns, crypto leads. In this video, we'll walk through Cathie's 4 biggest insights. Why the liquidity squeeze is already easing. Why the real macro force is deflation, not stubborn inflation. The gold signal from history that marks regime change. And what it all means for Bitcoin's next major move. Because if Cathie's right, the divergence we're seeing now isn't a warning, it's positioning. When Cathie recorded this video, sentiment was as bad as it gets. Markets froze, narratives collapsed, crypto plunged, while investors panicked. But she didn't see contagion, she saw a plumbing issue. And if you want to stay ahead of the market to spot when it's heating up or flashing those rare buy signals, join the Crypto Nutshell, my free 5-minute daily newsletter. You'll get quick, actionable insights and the latest news that actually moves markets, all delivered straight to your inbox every single morning. Just hit the first link in the description and enter your email to join. Let's get back to the video. The Treasury General account had ballooned during the government shutdown, starving markets of cash. The Fed's balance sheet had shrunk dramatically. Reserves were falling. Liquidity was being pulled out of the system faster than investors realized.
I know the markets are extremely nervous right now. The equity market and the crypto markets especially. And we think we understand why. And we also think this too will pass. Because there are some very short-term reasons, mostly having to do with liquidity drying up, again, very short-term, associated with Treasury and Fed balance sheet, or the Treasury General account and the Fed balance sheet primarily. And so we'll go into that in a minute. But we think that they will clear up within the next month. We have, first of all, quantitative tightening ending on, I believe it's December 1st. Now, many observers expected the Fed to end quantitative tightening with its last meeting. It did not. That was a little unsettling to the markets. And we're hearing from various Fed officials that there is more fear that inflation will not continue to unwind. We have a very strong view to the contrary, but the burden of proof is on us. The indicators have been sticky. Tariffs are one of the reasons, even though business has absorbed, we think, at least half of the shock from tariffs. So quantitative tightening, we think, will end December 1st. That's a de facto easing. And then the various liquidity tightening moves have to do with the Fed reducing its reserves. We're now down to 6.6 trillion. And at the peak, I think we were close to 9 trillion. The Treasury General account is at 940 billion. Normal over the last 3 years has been 600 billion. So the Treasury, because the government is shut down, is building cash and not releasing it into the system.
In this clip, Cathie breaks it down. Quantitative tightening ends December 1st. The government's reopening releases more liquidity, and the next Fed meeting could bring another rate cut. And now, we're watching that timeline unfold almost exactly as she described. The shutdown is ending, the liquidity drain is slowing, cash is starting to circulate again. And here's the key. Crypto is always the last asset class to stabilize during a squeeze and the first to accelerate once liquidity returns. Stocks and gold recovering before crypto isn't a bearish divergence. It's the classic pattern. Cathie's message is blunt. This wasn't structural damage. This was a temporary drought. And when the flows come back, the assets that were hit hardest, innovation, small caps, and crypto, are the ones positioned to lead the rebound. Headlines still say inflation is sticky. The Fed is still talking tough. But Cathie says that's the wrong battle. Money growth is at the low end of normal. Velocity is rolling over. And technology is quietly driving one of the most deflationary shifts in decades.
If we are right, we are moving into a highly deflationary age. And a lot of that is good deflation associated with technology. I know I've talked about the huge deflationary ramifications of robotics, energy storage, and especially AI. And those are playing out, we believe. But we have the tariffs, and we also have the lag in housing price measures. I think also oil is breaking down. It's below $60 on West Texas Intermediate. So we do have a lot of forces pressing down, and they've been obfuscated, we think, by lags in the data and by tariffs. But all of that is going to pass. We think next year it will become clear. And believe me, I know that I've been saying the risk is on the downside of inflation or deflation. And yet we've had these extenuating circumstances, and maybe I should have anticipated some of the lags. Nonetheless, I do think the bond market is beginning to understand that we're going to see inflation resolve to the downside, not remain stuck or even go up. Now, trueflation is that measure that we talk about a lot, which is, I think it's thousands, maybe tens of thousands of items measured in real time by this organization, Trueflation. The latest reading here is 2.5%. So again, kind of stuck where it's been for the last couple of years.
In this clip, she argues we're entering a highly deflationary age, not because demand is collapsing, but because productivity is exploding. AI tools compress costs, automation makes labor more efficient, energy innovation reduces the cost of production, but tariffs and lagging data obscure the picture, making inflation look stickier than it really is. The Fed is fighting yesterday's inflation with today's data, even though tomorrow's trend is already set. This mismatch, falling velocity, slowing money growth, rising productivity, means policy is more restrictive than it appears. So what happens when the Fed finally recognizes the true direction? They don't ease slowly, they pivot hard. That's why Cathie believes the next stage won't be a gentle drift toward loosening. It'll be a shift, a sudden one. And when that liquidity floodgate opens, the assets that multiply that effect, innovation equities and digital assets, benefit the most. Crypto isn't lagging because the tech is weak. It's lagging because it's the sensitivity gauge for liquidity itself. One of the most compelling points Cathie raises isn't about AI or inflation, it's about gold, and a chart almost no one is watching. She compares gold's total market cap to M2 money supply. This ratio has only peaked this high twice in modern history, the Great Depression and the late 1970s inflation crisis. Both times, those peaks marked the end of crisis and the beginning of massive bull runs in risk assets.
This is the ratio of the gold market cap to M2 and expressed in percentages. And what this is saying, given the rapid increase in the gold price during the past few years that we've seen, we wanted to assess, well, what does this metric look like relative to history? And what you can see here is two prior peaks near this level. One was in the Great Depression. And what happened is this peaked, I believe, in 32 or 33, and then it started moving down. We went through a reprieve in the Depression. Many people think it lasted throughout the 30s. It was at its worst in the early part of the 30s, or its most intense. And then in 1932, I think to 36, if I'm not mistaken, we had a reprieve and then a relapse in 37. During that reprieve, what we saw was money supply going back up. It had been declining, and the gold price was fixed back then. So all of this move was a function of money first declining. There was a deflationary bust, and the Fed wasn't picking up on it. And the Fed was fairly new, or they wanted to make sure not to let inflation out of the bag. And so they tightened way too much. Money collapsed. GDP went negative. Pricing went negative. And you see here the gold price to money went up to its highest level ever. And then they started easing. And the stock market had one amazing move after that happened, with the smallest stocks, the lower cap of the spectrum, having absolutely spectacular moves. So that's the first time this hit its peak. And then when it started down, we had a huge burst in the stock market. The second time we hit a peak here was in the aftermath, or it was the rise was taking place throughout the 70s, early 70s, 71. We closed the gold window, and you can see what happened. There was a flight to safety, a hedging against inflation that took place throughout the 70s and peaked in 80, 81 with inflation and interest rates, actually. And then after that, we had the golden era for actually both stocks and bonds. We went through a long period of disinflation, but especially the 80s and 90s were they were golden for the financial market.
She explains both moments. In the 1930s, the Fed tightened into a deflationary collapse. Money supply shrank, gold surged, and when policy finally reversed, equities took off. In the 1970s, inflation panic drove gold into a frenzy, until Volcker flipped the script, breaking inflation and setting the stage for 2 decades of growth. Now, we're back near those same extremes. Gold has surged, money growth has slowed, and the ratio looks stretched, historically a sign that fear is peaking, not beginning. But before we continue, just a quick reminder that only a small percentage of you watching are actually subscribed. If you're getting value from the videos, hit that subscribe button. It's free. It supports the channel, and you can always change your mind later. Let's get back to the video. Cathie's interpretation is contrarian. A strong gold market isn't a sign of doom. It's a sign that the system is ready for a regime shift. Historically, when this ratio rolls over, liquidity returns, and capital rotates from defensive assets like gold into productive ones like equities. But here's the twist. Bitcoin is now part of that rotation. In past cycles, gold stood alone as the monetary hedge. Today, gold and Bitcoin share that role, and Bitcoin tends to move faster. If history rhymes, we're sitting on the edge of a transition where defensive positioning unwinds and the next bull leg begins. Then there's Bitcoin, the question everyone cares about. After Cathie's CNBC appearance, headlines claimed she cut ARK's 1.5 million Bitcoin target. She didn't. She refined it.
The biggest surprise to us over the last, since we started our research on Bitcoin into actually 2012, is that stablecoins are starting to usurp a role that we thought Bitcoin would play. We thought Bitcoin would be an insurance policy for emerging markets against confiscation of wealth, either outright or through inflation and other terrible policies. What has happened is the stablecoins are taking over. They've hit almost $300 billion. And so we think that that insurance policy role will take $200,000 to $300,000 out of our bull price, which our bull price, of course, was 1.5 million. And we're public with that. That's why I can say this. But that was in an all other things equal world. What has also happened, of course, is what we've been discussing. The gold price has doubled. So the gold market cap has doubled. And part of our analysis for the potential for Bitcoin was that it it would take maybe it would become half the market cap of gold. It would take some share from gold or maybe expand the market. Well, that market has doubled. So I don't think our bull price should change all that much. And I probably should have been quicker to say all things equal on CNBC the other day. So I just wanted to clarify that. We are very bullish on crypto assets, but we know that they are the most susceptible to liquidity drawdowns. And I described earlier, we have a number of reasons for liquidity drawdowns now, but we think that they will be cleared by the end of the year, and hopefully by December 10th, when the Fed eases. And hopefully when government statistics come back and we get the employment report in early December.
In this clip, she explains that stablecoins have absorbed part of Bitcoin's original emerging market use case, the role of insurance against capital controls and currency collapse. In ARK's model, that shaves off roughly $200,000 to $300,000 from one specific pillar. But another pillar has grown stronger. Gold's market cap has doubled since ARK's original forecast, and Bitcoin's digital gold thesis ties directly to that. So while one component shrank, another expanded. The long-term outlook barely changes. Cathie also reminds us that crypto is the most liquidity-sensitive asset class in the world. It collapses fastest during a squeeze, but it recovers fastest when liquidity returns. And that's exactly the setup we're seeing now. Stocks stabilizing, gold strong, crypto still under pressure, but positioned to move violently once liquidity flips. ARK isn't backing down. They're still extremely bullish, not because of short-term moves, but because of what Bitcoin represents: a neutral, digital, global monetary asset built for a deflationary, tech-driven economy. That world is arriving faster than most people realize. Put all of Cathie's insights together, and the picture becomes clear. Crypto's weakness isn't signaling collapse, it's signaling sensitivity. Stocks and gold are stabilizing first, as they always do when liquidity squeezes begin to unwind. Meanwhile, liquidity is still tight but loosening. Money growth is slow, but velocity is falling. Technology is pushing costs down faster than policy can adapt. Gold's ratio to M2 is flashing exhaustion, the same pattern seen at the end of historic crises. And Bitcoin is sitting exactly where it tends to sit before a regime shift, compressed, coiled, waiting for liquidity to flip. Cathie's message hasn't changed, but now the backdrop is catching up. The government is reopening. Quantitative tightening ends soon. The next Fed decision could mark the official pivot. What looked like chaos is turning into a reset, the messy middle between fear and recovery. If her framework holds, this moment won't be remembered as the end of a cycle, but the beginning of a new one. Because eventually, every liquidity squeeze flips. And when it does, the assets built for the future don't just bounce, they reprice. This isn't the end of the story. It's the setup for the run Cathie Wood has been calling all year, the recovery that begins when most people stop believing it can.